Good afternoon and welcome to Scotia iTRADE's webinar. Today's topic is options in a neutral market with the Montreal Exchange. My name is Colleen Flines, the Client Education Specialist with Scotia iTRADE, and I'll be your facilitator for the next 60 minutes. So you should be able to hear us now, but just before we get started, let's just take care of some quick housekeeping items and then we'll dive right in. To test your audio, simply click on the sound check link in the audio panel as shown on the screen. It may show up as a settings link, and this setup window may be in your secondary screen if you're using two monitors. You can also use the hand signal to let me know if you're having any issues with the sound, but if you've got any questions, I'm going to show you where to use that in a minute. Now, everyone will be muted for sound quality purposes today. If you're using your computer speakers and you find that the quality of the audio is not that good, you can always telephone in by using the phone number you see on screen in your GoToWebinar panel and the access code along with your audio pin ID. As a quick reminder, unless otherwise expressly stated by Scotia iTRADE, seminars, webinars, and other educational tools and resources, collectively called the content, are provided by independent third parties that are not affiliated with Scotia Capital Inc. or any of its affiliates. Scotia Capital Inc. and its affiliates neither endorse or approve nor are liable for any third-party products or services, third-party content, or investment loss arising from any use of the content, including third-party content. So the information we're sharing with you today is for educational purposes only and for informational purposes. It's not intended to provide any personal investment advice and will be taken into account any specific objectives that you've got. We're strictly going to be going for educational purposes only today. And as a quick disclaimer as well too, the options, keep in mind that options do involve risk. They're not necessarily suitable for all investors, and they are intended for sophisticated investors. So before trading options, please carefully review the options account agreement contained in the Scotia iTRADE relationship disclosure document and terms and conditions. This document can be found online, scotiaitrade.com, in our forms library. Now today, you will be able to use the control icon in the GoToWebinar panel. The orange arrow that you see can be used to maximize or to minimize that GoToWebinar toolbar if you need more space on your screen. You can also use the computer icon there to view this presentation in full screen mode. Just click it again to bring it back to regular mode. And as mentioned, the hand icon can be used to notify any concerns you may have. Preferably, however, you would just use the question panel box that you see here on the screen to notify any questions or concerns that you may have. As we go through the session today, our presenter will either address questions as you ask them, or will save them for a question and answer session at the end of the session today. So just keep that in mind. Do keep your questions there, and we'll note them as we go forward. Today's session will be recorded. Tomorrow we'll be emailing you a link to the recording, say around mid-afternoon, so keep that in mind. You can also visit our YouTube channel. We've got a webinars on demand playlist there. The YouTube link is located at the bottom of the screen on scotiaitrade.com. Go to that website, scotiaitrade.com, scroll to the very bottom, and you'll see the YouTube link. And there, then you can go to the webinars on demand playlist to see all the archived webinars that we've got for you. We'll also be making available for you a PDF of today's session. I will upload that for you at the end of the session. It'll be the handout icon in your GoToWebinar panel. So at the end of the session, about 30 seconds or so, it'll take me to upload that for you, at which then you can download that. Today's session is being brought to us by the Montreal Exchange. They've got a Montreal Exchange Options Learning Series. As you can see on screen, it's from Series 1 through 5. We've covered pretty well much of them over the course of the past year. Today, Series 5, Part C, in a neutral market. We're going to be looking at implementing a trading strategy in a neutral market. So if you want to see some of the other series that we've got there, just go to our YouTube channel and search through those ones. You'd find the archived webinars for the rest of the series. Today we have with us Patrick Sresna. Patrick has been providing education on behalf of the Montreal Exchange for several years now. He specializes in analyzing the inter-market relationships of the broader derivative markets and the impact those trends have on trading and investment decision-making. So in addition to being an instructor, he's also the Chief Derivative Market Strategist for LearnToTradeGlobal.com. Patrick is a chartered market technician, a derivative market specialist, and a Canadian investment manager by designation. So at this point, I am happy to hand over to you, Patrick, and the session. Patrick, over to you.
All right. Hello, everyone, and thank you for joining us this afternoon. Let me just quickly share my screen here. Perfect. Conliffe, you can just confirm that that's the correct screen.
Correct.
No, perfect. Thank you very much. All right. So hello, everyone, and thank you for joining me. So today we wanted to cover a really interesting strategy on utilizing options or option strategies in a neutral market. And this is a really interesting strategy in today's environment. Like if you look at the Canadian stock market over the course of the year, for instance, using the XIU, which is the Canadian TSX 60 ETF, which is basically a representation of the Canadian stock market, is literally flat on the year. The XIU started at $22 and 60 or $22.70 at the start of the year, and is right now trading at $22.60. So we literally have a neutral flat market today, and that's no different. Any of you that own a lot of, let's say, Canadian banks, and you've been looking at, for instance, your shares of many of these Canadian banks more or less flat on the year. It's been one of those neutral markets. It's one of those markets where there isn't a lot of money being made on a lot of these Canadian names. And so this is where we want to kind of discuss, well, how do you make money in those environments? How do you turn around and profit from a period where the stocks or the markets aren't doing anything, or at least not doing any moves of significance? So the first thing I wanted to just point out, obviously the disclaimer, Conliffe earlier was pointing it out, we have a scenario where we just are doing this for educational purposes and should not be directly construed as advice. And so in today's agenda, we're going to discuss what is a neutral market, how do you take advantage of and what are the advantages of neutral strategies. We're going to then also kind of debate the disadvantage of them. We're going to look at all sorts of neutral strategies and do examples of trades such as an iron condor, which is what by name a more sophisticated option strategy, but one will understand that it really is just a strategy seeking to profit from a market that is generally inactive. And so with that said, let's just first of all define commonly what is a neutral market. And the easiest way to define a neutral market is that it's defined within a range. So you might have, in this case, this for a good chunk of that year, like for 3-4 months, you had a scenario where the stock neither went up nor down much. It stayed within a $41 to $45 range, let's say on this chart as an example. And therefore, when it's range bound like that, we like to define as neutral. Often, while this appears on this chart to be occurring at the top of the range and near the stock's highs, often neutral markets can just as equally occur at the bottom of a market. One of the simplest ways to perceive it technically is recognizing the fact that it is range bound, and it's range bound often by a lack of conviction of investors or traders to make any significant move within the stock or the security or fund or whatever it is. It's more range bound. So what we're going to talk about is some of the things that you can do as an investor to take advantage of this, to profit from a period where there's very little price movement, or far less price movement that is commonly done during a trending market. I think all of you can very easily understand what to do in a bullish environment. You basically buy and hold, because at that moment the stocks just keep rising and it's easy money. At the same time, when you have a range-bound market environment, there is no easy money. The stock is not appreciating anymore. So the thing is how do you position yourself to profit from that? Now, assuming some of you have taken or joined us for some of our past series where we talked about the theory behind options, because this webinar that we're doing together today is already assuming that you have at least some foundational understanding of what we showed and demonstrated in past webinars. But one of the characteristics of options is that there's a cost of carry. It time decays. I often like to use the illustration of, a car insurance policy. Even though that's far more linear in the way that it behaves, every day you're one day closer to your car insurance expiring. And what happens is, if let's say you bought a 1 year of car insurance and 6 months later you sell the car, you can ask the insurance company for the remainder of the premium unused for a refund, and so you use 6 months of time. Just the way an insurance policy, for instance, has a time component, and time costs money, in the same way an option has the same characteristic. And so when you are a buyer of options, then you're eroding the time decay. The time decay is actually eating up your profitability. But when we're talking about neutral strategies, like I'm going to explain throughout today's session, you want to open strategies where time decay is in your favor. You want to be able to say is that if the stock does or the bond or the stock or the commodity or whatever I'm selling these options on, that I'm benefiting from the fact that it's doing absolutely nothing. The other variable is you want to observe that in those neutral periods, sometimes you have a contraction of volatility. And so you want to generally be in trading positions that do not get hurt through volatility contraction. Those of you that are a little bit more sophisticated as traders may follow the VIX or the volatility index. And when you're looking at something like the VIX or the chart, what you see is that we're literally not historically, but we are a decade lows of implied volatility. And that is largely a reflection of the fact that as the market has been range bound, volatility keeps shrinking and contracting and in that manner. And so how do you open a strategy that the implied volatility doesn't hurt you as well? And so this is where we're going to talk about some of these neat strategies that you can consider implementing. So what are the disadvantages with some of the strategies we're going to cover? The one first characteristic often of neutral strategies is that they're not open-ended. The whole point of a neutral strategy is that you're anticipating a stock to do very little within that period, and so that any trade you overlay or put on to the you have to recognize that you're going to open a trade that is going to one degree or another limit your profit potential. Now, the other element that has to be taken into consideration is the complexity of a trade, because, for instance, when you are opening, like we will demonstrate towards the tail end of today's presentation, when you're opening a strategy such as an iron condor, you are going to have literally 4 legs of in the options combination, and you literally will need to pay commissions for each leg of the trade. And so definitely what has to be a consideration is how much transaction costs you're going to incur in implementing one of these neutral strategies. And while transaction costs are always a consideration and should always be respected and taken into account, that doesn't mean you shouldn't do the trade. What you're always seeking to do is make sure that the trade makes sense after you take into account those things like transaction costs. Now, the last point is some of the more sophisticated neutral strategies are structurally advanced in a sense that they have a lot of moving parts, and it's far more for the sophisticated investor than it is for a beginner that wants to keep their investing or trading straightforward and simple. So let's go through and discuss the different types of neutral strategies that are available to you as an investor. So what are some of the types of strategies that are out there? Well, one that we've covered in one of these 1-hour sessions in the past has been the at or in the money covered call. In selling a covered call, if those of you not familiar with it, you physically own the shares and you sell a call option for income to generate that yield or return. Now, by selling it at or in the money, you're in some cases extracting intrinsic value in the process and therefore reducing the net volatility that you're going to experience in the position. And so it gives you a cushion where the stock is just going to be chopping around range bound and you're sitting back and generating an income. Another neutral strategy is a collar, which involves the simultaneous purchasing of a protective put with that of selling a covered call to generate the income. And doing so, you're essentially reducing the cost of the collar and subsequently or the cost of the protection, and you've hedge wrapped your stock. You've given it a limited upside but a limited downside, and therefore are completely in control of your trading. Then the next thing that you can do is do what are called short straddles and strangles. This is the combination of long calls and puts, and the idea is that in a straddle or a strangle, when you're short or selling premium, so long as the stock does very little, you're going to sit there and benefit for the double the rate of time decay in a trade, and you're going to sit there and generate that cash flow. Another neutral strategy is also known as a butterfly, and it's the idea that you directionally are choosing the fact that the stock is going to do nothing. And so when you open an options combination like a butterfly, if you put the body of the butterfly in the neutral zone of your spread, anticipating where you think that the stock is going to be, which is neutral, it allows you to profit from your investment call that's going to happen. Now, those are all strategies available to you. Many of those we actually covered in past webinars, but today I want to focus particularly on two strategies: the credit spread and the iron condor. The credit spread being much easier, the iron condor being simply a little bit more complex in its nature. Now, the first observation I want to share with all of you is only the first three strategies: the strategy of the covered call, the strategy of the collar, and the strategy of the, actually, my apologies, the long straddle and strangle. No, so only the first two are actually available to you in your registered accounts. So those of you listening, if you have a TFSA or an RSP and you're learning about these option strategies as a way of taking advantage of opportunities in your accounts, then those neutral strategies are where, sorry, the first two are where you can actually implement them in your registered account. The short straddles, strangles, butterflies, credit spreads, and iron condors are only available to you in your registered accounts. Sorry, non-registered accounts. So you have to have a margin trading account, and you can obviously reach out to Scotia to certainly be able to clarify what type of an account you would need to do the strategy. But recognize the credit spreads and iron condors that we're going to talk about here, again, can only be implemented in that margin trading account. So let's talk about credit spreads. And credit spreads are an income-driven strategy. In the end, there's debit spreads and then there's credit spreads. Debit spread costs money. Credit spread earns you a credit or a cash flow. And the whole point of opening a credit spread is on your belief that, for instance, that the stock won't go a certain place. That, you know, especially if it's neutral or range bound, it's going to be more or less defined within that specific range. So let's talk about an example of credit spreads and how they work. And so you're selling those options for a credit. One of the biggest narratives of why you would choose the spread itself would take advantage of the time decay as share price remains neutral. And the last point is that keeping the full credit of the option is at or out of the money option at expiration. And so the point being here is that you want to choose an area where you believe the stock is not going to go. And so long as it stays out of there, the spread will profitably expire with no value, and you get to keep the entire credit. Now there's two particular strategies we're going to spend quite a bit of time, because the iron condor is simply just two spreads combined. And so really the two strategies that we're going to go into great detail for the remainder of the next 20-30 minutes is looking at bear call spreads and bull put spreads on there. And one is using call options, the other is using put options. Those of you that are new to options, obviously call options are the ones that are naturally have a positive delta, which is trying to profit from normally a rise in a stock, and puts normally would have with a negative delta are seeking to profit from a downside move in the market. And the point being here, this is a little bit contrary, because notice the word bear is put in front of the word call, and that means that we're actually trying to choose a spread with call options where we don't think the stock will reach. So for instance, let's just say I had a view, and this is, by the way, not advice, but let's just say I had a view that there's no way that Royal Bank is going to surpass $100 in the next 3 months. You know, over the long term it certainly can. But let's just say I felt that pretty comfortable in making the assumption that Royal Bank is not going to go up there. And so basically I can open up a spread, let's say 100 to 105, and simply have made a decisive call as to where I did not believe Royal Bank was going to be able to trade, and therefore the bear call spread, I generated an income from doing so, and I have a trade open that is basically defined where I don't think things are going to play out. Similarly, with a bull put spread, it is also defining at the bottom end of the range where you do not believe the stock will go on the downside. So using that Royal Bank example in the similar manner is that, let's say I didn't believe that Royal Bank was going to go under 90. Well, at that moment I could open a bull put spread, let's say between the 90 and 85 strike, and so long as Royal Bank never drops below 90, or at least towards the expiration is not below $90, then I'm going to have seen that the entire spread profitably expired, and I was able to profit from defining where I didn't think the stock would go. So let's actually take that first strategy and talk about this bear call spread, and sort of try to put into context how this bear call spread works. So here we're going to sell a call and receive a credit for having sold it. So at the beginning stages of this options training, we've covered the idea of buying a call and selling a call, and the contractual obligation between two counterparties to do business in the future on a particular stock at a particular price. And so a call, you sell the call and receive a credit. But because being short an option, now normally, by the way, a lot of people would do this trade as a covered call, which is they would physically own the shares of the stock, and the call simply obligates them to have to sell the stock in the future at a specific price. But because we're selling the call and do not own the shares, I'll repeat, for it to be a spread, we do not own the shares. I mean, there are different ways you can spread overlay. I don't want to say that it's impossible, but for the purpose of this credit spread, this ability to profit from a credit, we own no shares. So imagine here, if you had a $100,000 portfolio and you're sitting at 100% in cash. Here you're just literally doing a spread between two option strikes, and you don't physically own the shares, right? And so what happens now is that when we sell the call, we are purchasing a call option above the sold strike price to limit the potential loss. The cost is subtracted from the credit received. So if the underlying is at or below the written strike price, you keep the credit. And so you have a scenario where, in this scenario, so long as the stock never went up into the area that we defined in there. And so let's take a stock like, in this example, we made a fictitious stock DEF, right? And stock DEF, or company DEF, is trading at this time at $35. And so we have a $35 stock, right? And that stock could have been at 30, could have been at 40, doesn't matter. Right now it's at 35. And so the investor feels that it's likely going to stay within a range and that the stock is unlikely to do anything big. And so if you notice here, the options, we're looking at the $38 to $40 strike. So let's go back. Where's the stock trading? $35. And so what's happening here is that the call, we're selling the $38 strike call. And so by doing this, we're basically at least when doing it in a spread, we're basically making the call that we do not believe that the stock will surpass $38 come its expiration. It could temporarily trade above there and then come back down, but we believe generally that $38 will not be exceeded. Now, if you notice, the $40 call, which costs 60 cents, is what we're going to be buying as an offset. So it's a $2 spread, right? We have an obligation to sell the stock at 38 and have the right to buy it at 40, and the spread between 38 and 40 is $2. And so what we're literally doing is selling the $38 strike, receiving the $5 credit. So literally for every one call option controlling 100 shares, we received $105 cash. We then turn around and buy the $40 strike call for 60 cents as a debit. So we buy it when it costs us $60 per 100 shares to actually buy this $40 call. And so if we received a $5 credit for the one, but paid of that $5, 60 cents out for the insurance policy on it, creating a spread, our net credit was 45 cents. And so what we generated was $45 income for essentially anticipating that the stock is going to do very little within this range, and we are simply going to sit there and we just believe the stock might rally from 35 to 37, 38, come right back down to 35, but we don't think the price will be exceeded. And so the maximum profit when you place a trade like this is the net credit received. And so what you want to think is that if we receive for every one contract combination, or in this case for every $2 spread, we received 45 cents or $45 per 100 shares in income. So imagine we did this on 1,000 shares. We would have just made ourselves a $450 paycheck credit for basically anticipating that the stock will not surpass that $35 area. So the maximum risk is the difference between that lies between the credit. And so what you want to think is our worst case scenario loss is $2 per share. And so you have a scenario where we can't possibly lose, no matter what. It doesn't matter. That stock could have rallied to $50, $60. It's inconsequential to us because our maximum loss can only be the $2 difference between the two spreads. In this case, $38 and $40. And so your break even, if we collected 45 cents income, your break even is essentially $38 and the 45 cents that we collected as the income. And so we've created a scenario where we just are trying to profit from the fact that the stock is going to be neutral to range bound and that it was not going to have that big breakout on the upside. So that that is an example of that spread done with the put options. So the sorry, with the call options. So the question is, how do we do this with put options? And the theory behind the trade is very much the same. And what we're looking at is simply observing where we do not believe the market is likely to go. And so in this same context, what we're going to do is just go in the theory. What a bull put spread involves is selling a put option and receiving a credit for selling the put option and using the proceeds to buy another put option to limit or define the loss. This is also beneficial because of margin requirements. What ends up happening is that you only have to outlay a very modest amount of margin to be in a spread, while if you were naked the calls or naked the puts, you actually had to outlay a much larger amount of capital to be in the trade. So so you buy one and you sell the other, the cost is subtracted from each other, and you have that net credit that you receive. So the underlying is at or above the written strike price, and you keep the credit. So we have the same DEF stock here. So remember, we were talking about DEF earlier. It was a $35 stock. Remember, we did the call credit spread on it, which was between the $38 and $40 area up above. So what we're now alternatively doing is doing a bull put spread, which is we are selling the $32 strike, which is bidding $1.25, and buying the $30 strike asking 75 cents. And so what we've done is created a spread between 30 to 32. So with the stock trading at $35, right? So if you the first line company at DEF is at 35. What we're basically saying is we think the stock is going to be boring and neutral and do nothing, and it's simply not going to go below $32 while we're in the position. So I mean, it certainly can do so over many years, but it's not going to do it while we've opened the position. It has to be your outlook. And so in this scenario, remember the stock's at $35, so we sell a put at the $32 strike, which obligates us to potentially have to own the stock at 32, and we receive a $1.25 credit. So $125 for every one put option sold, which represents 100 shares. And we receive the $1.25 or $125 credit, and we use some of the proceeds to buy the $30 strike put, which is a 75-cent debit. And so what you can see here is that's a net credit of 50 cents. The spread is dollars. There's $2 spread, but it's the difference between receiving $1.25 in income and paying 75 cents out as a debit for the insurance policy. That leaves us again with that net 50-cent credit. And so what you want to think, our break even is $31.50, and we're basically making the call that we don't believe that the stock would be able to, or is not likely to go below $32 in that 1 month that we opened this trade. And so again, the maximum profit is the net credit. The difference between the strike price is less the credit, and our break even is that written strike, which is $32, minus the 50-cent credit, which makes it the $31.50 debit. Sorry, break even, 31.50 break even. And so you have your trading parameters defined. And so you can see here what we can literally do with credit spreads is say define a range. In this case, we said DEF was neither going to go higher than 38 in the bear call spread or below 32. And so long as, whichever way you express this trade, long as it stays above 32 and below 38, then the stock just does nothing, then you're generating income consistently off of a stock that is essentially doing nothing. Which brings us to the very strategy that is known as the iron condor. By the way, it's always amazing to see what kind of fun names that they come up with for all these option strategies. In the end, this is just a credit spread strategy. They just call it an iron condor because it's income-driven, boxing a very specific range. And so what you want to think is that the iron condor is a combination of both that bear call spread and the bull put spread executed at the net credit, and the risk is limited, limited risk with limited profit. So essentially, what you want to think is this: take that example of that DEF stock, and we open that bear call spread $38 to $40, and if we simultaneously did the $30 to $32 credit spread on below, only one of the trades could possibly go wrong, because if the stock's going up too fast, then the call spread will get challenged. But if the stock's going down, the put spread will get challenged. But both trades cannot get challenged at the same time. Only one leg of the trade could possibly be wrong. And what this does is it doubles your income, and essentially still allows you to know that both trades can't possibly lose. And by collecting a much larger net credit, you're able to have substantially reduced the risk even further. And so you can see it's what we call a four-legged strategy, and this is where transaction costs have to be very well accounted for. As if you are doing this with a single contract versus a larger size, and the transaction costs are simply eating up the profitability, then it reduces the quality of the trade. You have to kind of make sure that the commissions make sense in combination with what you're trying to execute. Nonetheless, you're trying to execute the same expiration month. It's called a four-legged strategy because it has four different strike prices. What is the most common way that traders will utilize this strategy? And that's to generate income, right? It's a neutral outlook strategy. And so you have, as an investor, feel the underlying security will trade within its range for a specific period of time. And so you're just anticipating that there's very little going to happen, and you more or less want to box that. And so here I have a chart, and you can see, like for instance, we have a stock that was for several months in an uptrend, and then just started trading sideways. And you can see through the months of April and May and June throughout this on this chart, the stock was just trading sideways, and not defining any specific range. And so let's just go through the scenario where you, as an investor, feel that this will be boxed within a range. And so in this scenario, what you're literally doing is you, let's say, sell that credit spread above, the bear call spread up above, and you sell the bull put spread below. And what you can see is that by defining this range, and say in this example I'm using $41 to $46, by defining this range, what you're doing is essentially saying, look, I don't think the stock is going to do anything for the next month or two, so long as it stays below 46 and stays above 41, then I'm just going to sit here and harvest income or cash flow while the stock is stuck in purgatory, trading sideways and not showing any conviction to follow through. And so this is how the strategy plays out. And so in this scenario, you have a company, remember, this stock is trading at $35. So this is the same stock scenario that we were looking at earlier. But in this situation, we simultaneously believe that the stock will neither drop below 32 nor really exceed 38 on the upside. And so you can see that those are the bids and asks on those different options chains. And so what you can see here is that we sell the $32 put and we sell the $38 strike call, and we receive $2.20 in gross cash flow. $1.15 for the 32 strike, $1.05 for the 38 strike. We received a total of $2.20 in credit. Notice to buy the insurance legs, the protective long options that are hedging out the risk, cost 60 cents each. So what you want to think is, if we receive $2.20 in income in and paid $1.20 out we paid $1.20 out in the protection, leaves us with a $1 net credit. Now, what's nice about this strategy, by the way, it works really if you're right about your call, but what makes the strategy neat is that if it doesn't work, the stock can only head in one direction, either higher or lower, which essentially means you cannot possibly lose on both trades. One of them is going to expire for a full profit, and the other may not. Only one can get challenged, and that's what makes these spreads so attractive to traders. Is that they're able to anticipate this far more neutral range and profit from that. So you can see it's a bull put spread. A bull put credit spread combined with a bear call credit spread, but when you do both spreads together, it's called an iron condor. Now, what we're basically doing is we have a $35 stock that we essentially feel will go no more than $3. So basically, think of it this way: $32 is I'm rounding, but it's about 10% lower, and $38 is about 10% higher. And so you basically have defined that I think that this stock is going to do neither of go 10% higher or lower, and I'm just going to sit here and harvest cash flow in having done so. So again, some of the different highlights is that the difference between the put strikes is minus the credit. So in this situation, the spreads on both legs are $2 wide, and in aggregate we collected $1 in premium, which means that they will only really even require us to maintain about $1 credit dollar margin to maintain what is our worst case loss. So think about what we've created as a scenario where you made $1 income for $1 risk. Because if let's just go through the scenario. What happens if you're wrong? Let's just say that you've opened this trade, and 2 weeks later, DEF announces that it's being bought out by some other company, and the company opens the next morning at $45 a share, expressing its monster premium in the stock move to the upside. Now, in that scenario, that means that you've just blown through the bear call spread on the upside. That basically means that your loss can now only be the $2 spread between the 38 and 40, but you still get to keep the $1 income. So in fact, your maximum loss, no matter, even if the stock went from 45 to 50, then to 55, your loss can never be greater than $1. And so you've created, in this, at least from a credit perspective, you've created a one-for-one risk-reward payoff, where your risk is $1 and your gain is $1, but even though it's an equal risk-reward, you may actually have like if let's say the implied volatility is 15-20%, you might have, let's say, a 68 to 70% math probability that stock will be range bound, and both legs of the spreads will expire for a full profit. So nonetheless, what you also want to observe where your break-evens are. If you made $1 income, right, then your break-even is in the middle of each spread. So you can have the stock drop even theoretically by expiration to $31 and still be a break-even, or it could even go as high as $39 on the upside and you'd still be at your break-even. The point being is that you're only hurt in the spread an iron condor if the stock makes an extraordinarily big move in either direction. And so long as the stock stays in a boring sideways range and just gets stuck in the mud and doing nothing, you're sitting there and harvesting cash flow in doing so. So what are your break-even points like I was showing? Well, the stock at $35, basically you can see that the bottom end of your iron condor is $31. The upper end of your break-even is $39. And really, so long as it stays by expiration in that 1 month below in that 31 to 39 range, then you're going to have made some form of money. It has to be between 32 to 38 to realize the full $1. So the way I kind of express it on on a chart looks like this. So long as the stock is somewhere between 32 to 38, you're going to realize the full $1 income, right? Your break-evens are 31 and 39, where that profitability goes from being $1 to being 0. And at the same time, if any price that's exceeded below 30 or above 40, your maximum loss is limited to a $1 loss, right? And so a lot of people that like doing these neutral strategies tend to find a stock that they believe is going to do nothing. Nobody's interested in, the stock's been doing nothing, and they sit there and they iron condor it and basically just hope that the stock literally does nothing. And notice how that is completely contrary to the way that we are trained as investors. Because as investors, we are taught to always find out what's hot, what's moving, what's going to go up, what are investors going to be trading, and what are they going to be looking at, what are they going to buy next, right? As investors, we're trained to chase the market and look for the hot stuff. What's interesting is that when you apply a neutral strategy such as iron condors, you're no longer defined in terms of you making money by a stock that you're directionally right about that's going up or down, but rather you simply have to identify stocks that are doing nothing and are likely to continue to do nothing. And if you and sometimes, and surprisingly, if you explore the way that that you screen for stocks, sometimes it's not that hard to find stocks that are doing nothing, that are likely to be stuck in some stock market purgatory, that are just going to end up being range bound. You know, I'm just hypothesizing that, you know, will crude oil prices stay stuck within a range or something of that manner? You know, there's all sorts of different trades you can express this idea of whether something is actually going to go higher or lower. So margin requirement, typically, I mean, and by the way, I do want to stress that you should definitely double check with Scotia what their margin requirements are, because it does vary sometimes from one brokerage to another based on their risk departments and compliance departments. But it is common for margin requirements to only be one leg of the spread, because you can only lose on one trade. And so long as you have the spread covered in the account, that is all the margin that the brokerage requires for you to actually open it. So you, in many cases, you only needed $1 to have this trade open. In terms of your capital outlay to open the iron condor. So you can see things like transaction costs are far more burdensome than it is the capital outlay. The impact of volatility, it's moderately negative. You want to recognize this with spread trading. You're usually Vega neutral, which is basically that volatility. You have long options, short options, and usually the volatility changes are being hedged out within there. It's not like being short a strangle or straddle trade where volatility risk is a major component that has to be accounted for. Nonetheless, the investor has to will be limited in the stock movement within the time frame selected. So what are some of the impacts of time? Generally, it's positive. What you want to think is that when you open Iron Condor, you are open to credit that is working over that, let's say, 1 month to expiring at zero value. And so what you want to recognize is that you're looking for this to expire worthless for the max profit. So there is a positive theta, which is that you're profiting from just sitting on your hands every day. A certain amount of the time decay makes the trade more profitable if the stock price hasn't moved. The risk to, at expiration. This is, I think, the trickiest part, especially if you utilize a substantial amount of leverage. What you want to think is that if any written strike is in the money, so let's say in this case the DEF stock is above 38 or it's below 32, there's always the risk that you can be exercised or that someone will exercise and you will be assigned prior to the even expiration. This is a small risk. It doesn't actually increase or decrease the risk of loss in terms of that if you get assigned early on a leg, that somehow you're going to lose more money. It doesn't work out that way. It's actually mathematically the same risk. What though does change is that you may not have had sufficient margin or capital in the account to take on the assignment, in which case you would have to, in those circumstances, unwind the whole trade, and it's just a matter of closing it. It doesn't really increase or decrease your loss if you did get exercised, but it will incur the transaction costs in unwinding the trade, right? And it may involve a phone call from the credit department. In some cases, if it is a risk. Generally, so long as you pick your ranges properly, you don't have to worry about it. But understand, if you're especially going into the last week of expiration or into a big dividend payment, and one of your option legs is in the money, you do want to respect the risk that there's a chance you might get exercised. If you do nothing, let's say the stock gaps to $45, right? And it's a takeover. The stock's gapped up there, and you have this $38 to $40 spread on the bear call side on the credit. Well, if you do nothing and both options are in the money, then they will offset each other. So you're literally going to sell at 38, buy back at 40. It's going to be a $2 loss minus the dollar income that you made, and you'll see that it reconciled into your account as a $1 loss. The max risk we defined, but that will happen automatically. You may want to double check with Scotia just what kind of transaction costs that would be incurred if that was exercised that way. So it's something you just want to become familiar with so that you don't have surprises when you've placed a trade. As well, the investor would assume that the unidentified risk of being long or short the underlying shares. Again, I want to say when you say risk, the bottom line is that the one option is hedging the other. If, for instance, I was forced to buy the stock at $32, where we sold the $32 put, I do have a $30 put that's insuring the downside risk below 30. And so when you say as an undefined risk of being long or short the stock, it isn't really undefined so long as the other leg of the option strategy is there. The only way that you become fully exposed to equity risk is under the circumstances where you get exercised on one leg of the options and all the other options all expire, and you're just stuck holding the stock after the option expiration. Now you're a shareholder, right? At that moment you own the stock the way any other investor does, and you're exposed to all of the risks an investor normally would, because at that moment you'd have to own the physical shares. Generally, these are obviously disclaimer things that we're pointing out, but most traders will trade around this. They'll open their positions, they'll close out their positions if they're being challenged. There's different ways of managing the iron condors as you go. So in conclusion, neutral strategies can be used to generate income. The expectation is that the underlying security will trade within a range. Some strategies can be created with limited risk, such as credit spreads. Some require significant margins, such as short straddles and strangles, but other ones like credit spreads and iron condors require very little or almost no capital. Now, I wanted to draw all of your attention over to the Montreal Exchange website. So, now, while Scotia does do a fabulous job providing all sorts of great content for all of its clients, at the Montreal Exchange, we do as well provide all sorts of additional great resources for free. Now, what is actually not on here, which I encourage all of you to check out, is what's called Options Play, which is a screener and a strategy builder that is now built into the Montreal Exchange and provided for free. Normally, if you're, let's say, looking for the Options Play down in the U.S., you're paying, $50+ a month for U.S. options. You can actually go through the Canadian options market completely for free using this amazing resource and tool. It's available all on the m-x.ca website that you see down there. The Montreal Exchange spends a lot of time and effort to make sure that all of its all Canadians have the ability to properly learn what options are and how they work. And so take advantage of both the resources offered by the bank and as well from the exchange. Lots of great content out there for all of you to review. With that said, we'll open up the floor for questions. Conliffe, if you want to come in here and moderate that, I'll be happy to stay around and answer any questions that all of the listeners may have.
Okay, great. Thank you so much, Patrick. We do have two questions right now. And the first one, Olga indicated that it sounds a bit like gambling. What would you comment on that?
Well, thanks for that question there, Olga. I mean, there's an ambiguity to all markets, I guess you would want to put on that. Like, in the end, when you buy a stock, will the stock go higher or lower over any short-term period of time? Everything, to one degree or another, is based on probabilities. I mean, maybe when you look at this, the way that this is presented, it does, appear like you're making a very specific bet that this will happen. And that really is how options can be utilized as an alternative. So, like, for instance, an investor that just owns a stock and it's neutral, well, they might get a positive carry from just a dividend being paid, but the stock is just chopping higher or lower. A strategy like this gives you an alternative mechanism to, let's say, generate income on a relatively neutral strategy. That's an alternative to just holding an investment that's paying a positive yield as an alternative. But everything essentially in the markets is probability based. In the end, there's no one that can tell you that something is going to happen for sure, right?
Great, thank you, Patrick. The last question that I have so far, whom do they call a stock market shark? What is the shark investing?
A shark?
A stock market shark. What is shark investing?
I actually, well, that's a good question. I mean, I don't use the term shark investing, so I actually don't have an answer to that. I'm not certain. I mean, I would assume that when you're thinking of just what I would think of when I hear the word a shark investor is someone who's going into the market to, I guess, almost take advantage of some scenario or to profit from someone else. I'm not sure. I've never, to be honest, I don't know the definition of it. So I wish I could help you out.
Okay, we can actually follow up on that for you, Olga. Well, thanks. Those are the two questions we have so far, Patrick. Thank you very much. Thank you. That was a great presentation. Lots of information, and I'm sure our attendees will be able to utilize some of that to enhance their investing. Oh, we've got one more question here. Just bear with me. George is saying, not related to the presentation, can we buy Ethereum or other cryptocurrency in Montreal?
Well, no, the Montreal Exchange is a derivative market, but it isn't. It does not have the cryptocurrencies. The cryptocurrencies are not, at least as far as I'm aware of. I don't want to say for certain, but those are available through their own exchanges. They're not something that is offered through the primary markets of the TMX or the Montreal Exchange.
Great. Thank you so much.
Otherwise, Conliffe, I just wanted to say thank you for having me, and thanks for all the listeners listening in. It was a pleasure working with you over the last hour.
Beautiful. Thank you, Patrick. I really appreciate that. Thank you. And thank you for the listeners. So what we're going to do now is we're going to change the presentation back over. We're going to do a quick wrap-up on this session here. So bear with me a moment. I'll orient my screen. Okay. So coming up next, as I mentioned before, you can access our webinar recordings on the YouTube channel, or you can email us at education@scotiaitrade.com to request a copy of the recording link. Now, after you exit the webinar session, a short survey will load. For those of you who have attended webinars in the past, you're familiar with the drill. But certainly for those who are new, a short survey will load up. We just ask that you please complete that and let us know how we did today. And also, if you've got any other presentations that you'd want to see, any other topics presented on in the future, do let us know, and we'll be able to try to accommodate those for you. And coming forward to us are two webinars I want to highlight right now. On July 7th, Friday, July 7th, Trading Options in 3D by Pro Market Advisors. That's for those who would like to sharpen your skills. Level 3, Trading Options in 3D by Pro Market Advisors. And then following that, Horizons ETFs has a ETFs 101 on Tuesday, July 11th. And that's for those who are just starting out, getting started. So July 11th, Horizons ETFs will be providing an ETF 101 for us. So just go to the Education tab under the ScotiaITRADE.com website, click on Events Calendar, and you can register for those or any other webinars you see there of interest to you. So on behalf of Scotia iTrade and the Client Education Department here, I'd like to thank all of you. I'd like to thank Patrick Sresna for a wonderful presentation, and thank you for your time. I hope that this was informative for you and will be used for your investment purposes going forward. What I'll do now is I'll upload the presentation for you so that you can have that going forward. Bear with me a moment as I go into the presentation here. I will provide that for you. Options in a neutral market. In about a couple seconds, it'll be uploaded, and it is now done. So just click on the handout icon in your GoToWebinar toolbar and download that PDF presentation I put up there for you. Once again, thank you for your time today. We've run over just a little bit. We do apologize. But we hope that this was informative. Have a great day, and we look forward to seeing you next time.